Hi folks, welcome back to Murthy Finance Academy. Today we will be discussing an interesting company from trucking industry, which is none other than BlackBuck Limited. So the company which is digitizing the dashboard of Bharat's trucking industry. So the Q3 fiscal 2026 delivered a massive 53% revenue jump, EBITDA growth of 49%, and a clear shift to 31.72 crore PAT. Operational velocity is accelerating, with transacting customers hitting 831K and GTV processing scaling 23% year on year to 7,500 crore. The real question, can BlackBuck scale the high touch Superloads engine without breaking the high margin payments machine? So, India's trucking industry has been a fragmented labyrinth of individual operators and manual middlemen. So, here BlackBuck, which is nothing but Zinka Logistics, is effectively the digital operating system for this ecosystem, moving beyond simple tolling to digitizing the entire operator lifecycle. By embedding itself into the daily workflow of the trucker, the company has transitioned from a convenience play to a mission critical platform. The competitive landscape remains broken into silos. In tooling, BlackBuck competes with traditional banks that often treat commercial vehicle operators as a retail afterthought. In telematics, it faces specialized private players. Even public peers like Delivery are occasionally cited as competitors, though BlackBuck's focus is uniquely upstream, owning the operator relationship rather than the just movement of goods. The forward hook is a massive transition. BlackBuck is evolving from a pure payments gateway into a full stack logistics ecosystem where loads, financing, and high frequency operations coverage. So, to value Zinka Logistics, one must look the past, the logistics label, and recognize an asset-light, platform-led model with immense operating leverage. BlackBuck doesn't own the trucks; it owns the relationship with the people who do. So the company got incorporated in 2015, and its core revenue comes from core business, which is payments, including tolling, fuel, and telematics. And the second business is growth business, where it offers superloads, loads marketplace, and vehicle finance. If you see its scale metrics, it is having 831,348 transacting customers with a presence in 80% plus of India's districts. So the crown jewel is moat is user engagement. The BlackBuck app sees a staggering 44-minute daily average usage among transacting customers. This digital stickiness is anchored by a physical mode, a network of over 10,000 physical touchpoints, providing a feet on street technician and sales presence exactly where truckers live and work. So, BlackBuck is currently processing nearly 2,500 crores in GTV every single month while growing its multi-service user base at 20.3% year on year. The investment thesis rests on simple, relentless platform math, grow volume by transacting users, deepen the mix by moving users from one service to two or more, and harvest the margin via the operating leverage and generate cash. The market frequently misses the stickiness inherent in this funnel. There are now 420,000 users already using two or more services. Once a tracker relies on BlackBuck for tooling, telematics, and the next load, the switching cost becomes prohibitively high. It is no longer a service, it is the operator's entire digital office. So the second half of the financial year is traditionally the power half for the commercial vehicle industry, driven by festive demand and heightened economic activity. BlackBuck is utilizing these tailwinds significantly outpace the broader market. So its tolling dominance. BlackBuck maintains a 50% market share in the truck tolling segment. And while the industry growth in tolling was 15%, BlackBuck delivered 24% GTV growth. They are essentially cannibalizing market share from traditional banks at nearly 1.6 times the industry space. Success isn't without friction. The company faced a specific cost factor in Q3 due to wages labor code regulations, resulting in a 3.83 crore exceptional hit, underscoring the sensitivity of their massive physical distribution network to labor law ships. So the company separating the mature cash cow from the venture growth segments is an essential for accurate valuation. So its core business payments and telematics segment grew 31% year on year, This is the profit engine funding future bets. And its growth business like Superloads and vehicle finance exploded by 271% year on year. And tolling specific 24% GTV growth year on year, processing 7,500 crores in Q3. Its vehicle finance with 35% QOQ dispersal growth. This is a partner-led model. BlackBuck earns commissions while avoiding the full credit risk on its own balance sheet. Contribution margin also remained robust at 93.4% of net revenue, showing the efficiency of the platform. So, while PAT has turned positive, adjusted EBITDA is a metric that truly defines the platform's trajectory. It grew 51% year on year to 50 crores, signaling the core engine is generating the firepower needed to scale Superloads. Its revenue margins also 53% revenue jump is impressive, but the bottom line is being calibrated by design. Management is stepping up Superloads investment, specifically off-roll manpower and infrastructure, capture the marketplace early. And in terms of balance sheet and efficiency, the company remains debt-free. Critically, debtor days have improved from 39.8 to 24.2, a massive win for working capital efficiency in a traditionally credit-heavy industry. So BlackBuck is a rare breed, a tech platform growing top line at 53% while remaining debt-free and profitable is a big thing. The quality of this profit is high, driven by 93% contribution margin and a rapidly improving cash collection cycle. Post listing, management has shifted from testing the waters to aggressive expansion. CEO Rajesh Yabaji and CFO Sachikam Naik are signaling that the private market blitzscale DNA is intact. So if you see the company's market share is pretty much closer to 50% of the level range. So they aren't just holding the fort, they are winning the majority of new trucks entering the market. And for the playbook for Superloads is at around 50 to 60%. So if this model already hitting 3 to 4 months break evens at only 50% readiness, the 100% playbook represents a massive potential for margin expansion. And the company is also working with SMEs. So here, by avoiding corporates, BlackBuck avoids a working capital trap that plagues peers like delivery. And the company is also leveraging tech and AI so for accelerating this marketplace. So tech is being used to automate the matchmaking between truckers and loads, reducing human intervention. So the company knows how to navigate the public markets, but they have been actually aggressive as we were in the private market. So here management is signaling that public scrutiny won't slow their expansion velocity. So the bottom line is leadership is delivering. Core business margins are expanding as predicted, and they are successfully recycling those profits into new bets without stressing the balance sheet. So the North Star for BlackBuck is platform density and operator stickiness. Its monthly transacting operator stands at nearly 831,000, which shows its market reach, and multi-service users are around 420,000, which shows deep loyalty. And its gross transaction value (GTV) is at around 7,500 crores, which is quarterly throughput. And app usage is nearly 44 minutes, which shows its user attention. And ROCE is around 10.5% and ROE at 47.3% and a PE of 27.5. So with 53% top line growth, price to sales and PEG ratios are far more relevant than trailing PE. At a PE of 27, BlackBuck trades at a discount to the median peer of 30.2 despite significantly higher growth. This is effectively a PEG of less than one story. In a bear case, Superload scaling stalls due to hub execution failures, off-roll manpower costs spike PE contracts to around 15 times. In a base case scenario, if 30% plus growth continues, Superloads hits 14 cities by June 2026 with 5-month city level break evens we can see. And in a bull case scenario, if breakout signs in Superloads lead to 50% EBITDA conversion on commissions, acquisition market share hits 65% as banks retreat. So here price to sales is the only sane metric here given the 53% growth. At a 27 times PE, you are paying a fair price for the core utility business while getting the explosive Superloads venture option for free. So what are some key risks in this company which I found? Are execution complexity. The platform is secular across India with 70% share in Rajasthan, 50 to 60% in Andhra Pradesh. But the Superloads rollout is a hub and spoke model. Success depends on the difficulty of activating new physical hubs where manpower and infrastructure will require rather than a lack of supply. And next, off-roll labor inflation. Other expenses here we can see rose to 18 to 90 crores largely driven by off-roll manpower. Regulatory shifts in labor codes could make this as a permanent margin drag. And the third is manpower execution. Moving from a low-touch payments app to a high-touch load broker like Superloads require a massive disciplined workforce. And shareholding. Promoter shareholding decreased by 2.07 percentage points from 27.19 to 25.12 over the last quarter, which is a key thing to track. And some key monitorables are its city count, reaching 14 cities for Superloads by June 2026. Second, margin protection, maintaining 93% plus contribution margins as growth business scale. Third, break-even cohorts, tracking the 3 to 4 month break-even timeline for new Superloads hubs. And the fourth, growth gap, monitoring if gross transaction value growth continues to outpace the industry of 15% growth or not. And revenue per employee trends in productivity as other expenses climb. And last is institutional interest. Watch for FIs currently around 28.25% to continue their accumulation. So BlackBuck is a rare rule of 40 candidate in the Indian market, blending hyper growth with genuine cash flow. Its dominance in tooling provides a high margin floor that funds aggressive swings at the loads marketplace. Watch the 420K multi-service users and the superload city count. If these climb, the current valuation will look like a bargain. Management's aggressive private market execution style is successfully satisfying public market scrutiny. The platform is working. Hope you like this video. If you do like this video, please do like, share, subscribe to Murthy Finance Academy. Thank you.